What's up guys, Tex here. In this video, I want to share with you this spreadsheet that I made that can help you get your money invested in the stock market in a very mechanical and structured kind of scheduled way versus trying to time the market. Because when we're talking about long-term investing, it's more about the time you spend in the market versus trying to time the market. Study after study has proven that trying to time the market severely diminishes your returns. So if someone asks me, hey, I've got some money ready to invest, when should I buy? My answer would always be immediately. The sooner you can get in, especially when you're talking about long term, right? If you're not like literally fixing to retire tomorrow, the better off you'll be because you'll have plenty of time to ride out any ups and downs in the market. And the longer that you hold out and getting in the market, the more odds that you're really going to miss out on a lot of returns on your money. Furthermore, when you have cash just sitting in a savings account, it's actually losing value due to inflation over the long run. So you want to be putting your money to work for you. And one of the best ways to do that is to invest in something like the stock market. Now, I am not a financial advisor, so please do seek professional advice as far as your particular situation, where you are in your goals towards retirement, how much risk you want to take in your portfolio. All of these things need to be very carefully considered with a professional, ideally. But basically, you need to come up with your asset allocation and essentially how much risk you want to take. Usually, riskier portfolios are going to be heavier in stocks with the potential of greater returns, but also you will be impacted more by wild swings in the market. If the market has a recession or whatever the case may be, you're going to take a bigger hit the heavier you are in stocks. But again, if you're a long ways from retirement, you have more than enough time to ride out any of these swings, and you're going to be utilizing a cost averaging strategy that allows you to add money to the market as it becomes available to you year after year after year until you reach retirement and your money has grown for you exponentially, especially with the benefit of compounding interest. So for compound interest to do its thing, you've got to get started early. And that's why, most of us who are traders, it can be difficult trying to decide when to buy because we want to buy dips and sell rips, right? But really, long-term investing, you just got to get in the market. And hopefully the spreadsheet will help you out in regards to that. So again, I'm not giving you any investment advice, but if this tool helps you out, do me a favor, do hit that like button. I really appreciate it. It helps me out, shows me you enjoy the content, and it helps the channel out with the YouTube. All right. Once we have calculated our asset allocation, it's just as simple as coming in here and inputting that data in. Now, everywhere you see white boxes in the spreadsheet is the only place you're going to input data. The blue boxes like here are automatically calculated for you. So basically, again, a more aggressive portfolio is going to be heavier in stocks. So for me, example, I'm at 60% in US stocks, 25% in global stocks, 15% in bonds, and I have nothing in REIT, which is like real estate. You could use some other alternative investments. Say, for example, you wanted exposure to commodities or gold in your portfolio. Maybe you put gold or commodities or whatever the case may be here, just some alternative investment besides your traditional stocks and bonds. And then maybe cash if you want to keep some cash in reserve in your account. Usually you would only keep cash in your account if you're close to retirement or you're already, paying yourself money to live in retirement, for example. You would have to keep some cash in your account in that example. But the further from retirement you are, the better off you'll be not really leaving much cash in your account because, again, it's just going to lose value from inflation. All right, so this would be my asset allocation. It's a more aggressive asset allocation. But the point being is you set this to whatever your particular situation is, and you want to make sure that your total allocation here equals 100%. So you'll notice if I put like 10% in cash, for example, now my total allocation says 110%, and obviously we can't have that. It needs to be 100%. So we go back to zero in cash, and we're all good. Once we get our asset allocation set, now we want to come down to principal investment. So let's say, for example, you have nothing invested in the market, but you just opened your first Roth IRA. Good job. Huge kudos to you. Now you need to get money into the Roth IRA so that you can invest. A Roth IRA is simply a vehicle for you to put your money into. You've got to then take that money and put it in the market to put it to work for you. As of this year in 2020, the maximum contribution to a Roth IRA is $6,000. Let's say you've just got $6,000 in your savings account that you're not using. You might as well go ahead and put that in your Roth IRA and put it to work for you. So if you have the capability of doing that, you could just say, boom, I'm going to open my Roth IRA. I'm going to put $6,000 in right now. So you just put $6,000 into your Roth IRA. It's sitting in the account ready to go. That's how much you have to invest. That's how much you would put here. Let's say, for example, though, you only have $500 a month to contribute to your Roth IRA. And if you do that every month throughout the year, you will have contributed $6,000, thereby maxing out your Roth IRA by the end of the year. So you just contributed your first $500 to your new account. That's exactly what you'd put there. All right. So whatever your principal investment is, that's how much you put there. All right. So what I'm going to show you first is $500 because that's probably going to be more common. Most people are going to contribute to their retirement accounts month by month as they have funds available from their paycheck, for example. So you just open your account, you put $500 in, it's cleared, ready to trade. You put $500 in here based on your asset allocation. This is going to tell you right here how much you need to invest in each asset, right? $300 of that $500 goes into US stocks. $125 of the $500 goes into global stocks and $75 goes into bonds. Nothing goes into REIT, and we keep nothing in cash, right? If I come in here and put, for example, 5% in REIT, 10% in bonds, now you can see how the asset allocation has changed. So it's going to change based on what you set here. Just make sure that your total allocation always equals 100. So let's go back to 0% on REIT and 15% in bonds. We're back at 100, good to go. All right, so you just contributed your first $500 to your Roth IRA. As soon as that money is available to trade, go ahead and buy $300 in US stocks. You could buy index funds, ETFs like the SPY that tracks the S&P 500. Something, it could be individual companies, however you want to handle that. That's obviously something that you need to decide, but just get broad exposure to the U.S. stock market is the best thing you can do. They actually have total stock market funds in an ETF version and in a mutual fund version. So something like that is really super easy to invest in, and you're good to go. I personally have both mutual funds and ETFs in different accounts that track the total stock market. So it works really, really great. You have a very diversified portfolio among the whole stock market in the U.S., and you only have to buy one thing. All right. So buy $300 in US stocks, and then $125 in global stocks and $75 in bonds. And then as soon as you do that, you'll have your entire $500 invested. Now the next month rolls around, you contribute your next $500. As soon as that money clears, immediately go ahead and invest the same amount. You do that every single month over the period of a year, and you will have $6,000 invested, which looks something like this. $3,600 would be in US stocks, $1,500 would be in global stocks, and $900 would be in bonds. Now, going back to this situation, if you had $6,000 to invest or to contribute immediately as soon as you opened your account, so you put your $6,000 investment in here, and again, that shows you how the $6,000 is invested. But let's say you want to take like 3 months to get that $6,000 invested. You don't want to do it all at one time. Then come over here to the monthly investment timeline, and that's going to tell you over 3 months if you invest $1,200 from the $6,000 into U.S. stocks, $500 into global stocks, and $300 into bonds. It would take you 3 months to get that entire $6,000 invested. Maybe you want to stretch it out a little bit longer. Here's 6 months. You would invest $600 a month into U.S. stocks, $250 into global stocks, $150 into bonds, and so on. So you can quickly see that it really removes the whole emotional thought process of, is this a good time to buy? Is it not a good time to buy? It gives you a very structured and detailed schedule as far as to how to invest. All I do is literally, like, on the first of the month when I pay my bills, I also have a reminder to check my investments. I'll log into my account. I'll look in how much money that I have to invest. I've already calculated it out on my spreadsheet, so I know, when the first of the month rolls around, the reminder goes off on my phone. Let's say, I'm investing $6,000 over a period of, 6 months. Then I know that I need to go in and invest $600 into U.S. stocks, $250 into global stocks, and $150 in bonds. I don't have to think about it. I just automatically go in, every month and invest the amount that I need to invest based on my particular plan. Okay, so pretty straightforward. I included all the way out to 2 years on here just for some perspective. Obviously, you're probably not going to take 2 years, hopefully, to get $6,000 invested. I wouldn't stretch it out that long, but it gives you a little bit of flexibility in the plan. If you want to just like slowly cost average in, you can see all the way up out to 2 years. Now, let's say, for example, that let's just say you already have money invested in the market. You have no cash on hand. You're totally invested, but you want to reallocate your portfolio, maybe to remove some of the risk, get rid of some of the stocks and go a little heavier in bonds, for example. So just for demonstration purposes, let's say you've been investing for a little while and you currently have $20,000 invested. We'll just keep it nice and round so the numbers are easier. But let's say, you've got 20,000 invested and this is your current asset allocation. You're 60% in stocks, 25% in global stocks, 15% in bonds, nothing in REIT, nothing in cash, total allocation, 100% good to go. And this is how much you have invested in each of those asset classes. All right. Now, if we wanted to rebalance our portfolio, we would basically just come in here and adjust these percentages to whatever we want to rebalance to. Before we do that, we need to log into our account and get the exact numbers from our brokerage account as far as how much we have invested in each asset class. Now, we know from here we have 20,000 invested, and so we can just simply look here, but you want to get these exact numbers from your brokerage account. And you're basically going to input those right here. So input how much you're currently invested in US stocks, global stocks, etc. So from this example, we know we're invested 12,000 in US stocks. We have 5,000 in global stocks and 3,000 in bonds. And then we have nothing in REIT and nothing in cash. All right, so that's how we are currently invested, and that comes out to $20,000. So once you've inputted your current investments here and you're ready to rebalance your portfolio, you come in here and adjust your asset allocation. So perhaps we want to go 40% US stocks, 10% global stocks, 40% bonds, and let's say we want to raise 10% in cash. All right, so our total asset allocation equals 100, so we look good. Clearly, we reduce some of the risk. We're a little lighter in stocks and we're heavier in bonds. All right. Now, based on the fact that we have no new cash to invest, we just simply want to move our money that we have invested around into different asset classes. We come over here, and with the numbers that we plugged in here, it's going to tell us our reallocation amount. So any negative numbers tells you how much you need to sell, and positive numbers tell you how much you need to buy. So clearly, we have 12,000 currently invested in US stocks. With our new asset allocation, we would actually have to sell $4,000 worth of US stocks. For global stocks, we'd have to sell $3,000 worth, but for bonds, we'd actually be buying $5,000 worth of bonds. And for REIT, that remains on zero. And you can see that we would also be raising $2,000 in cash, keeping 10% of our entire, basically our entire investment amount in cash. All right, so there you go. That tells you exactly, and this would be basically immediate, right? So you might want to do it a little slower if you wanted to reallocate over a period of months. Then obviously you would just divide this out by however many months you wanted to take to sell these assets and buy. But you get the idea. It just kind of gives you, very quickly exactly what kind of dollar amount you're looking in terms of reallocating your assets. All right, so hopefully that is helpful to you guys. Like I said, I am definitely not a financial planner. I just wanted to make this spreadsheet to make it easier for me, so I had everything all in one place. Since I have some new accounts that I started and some existing accounts, managing both my wife's accounts she's been investing longer than I have. So we have different situations between both of us. So it was nice to have a spreadsheet all in one where, if you're just getting started or maybe you also want to rebalance an existing portfolio. All right, guys. Like I said, do me a favor, hit the like button if you found the video helpful. Lets me know you did enjoy it, and I always appreciate that. It really does help the channel out. And feel free to leave any comments or questions below if you have those. Until the next video, thanks a lot for watching. Take care, and I will see you then.